Thank you everyone for joining us in today's online discussion of growth versus profitability. Which story do investors and buyers believe? Which is essentially a different approach to the classic question of should I raise capital or sell my business? In a more rounded or like down to earth question, which is that other debate of growth versus profitability, what's more important nowadays and how the market has fluctuated. To address this question, we have two great experts on the matter. Sergey Dean from Orion VC, which brings the investor perspective, and Juan Ignacio García from L40, who brings the former founder that has exited a business and the M&A acquirer perspective to the table. And before I make a fool out of myself and try to introduce them, guys, I'm sure you'll do a way better job than me at talking about yourself. So maybe, Sergey, if you want to start and introduce yourself to the audience.
Yeah, let's go. Yeah. So nice to meet you all, guys. I'm Sergey. I'm now partner of Orion VC, early stage venture capital firm where we invest in very hard to build, easy to sell industries like AI infrastructure, robotics, and vertical AI. And I'm a mathematician by training. I've spent some time at McKinsey, but pretty quickly switched to founder mode and build several businesses. Have one which I sold. It was like deeply technical, medical tech, AI business, which I believe I will tell more during that meeting. But yeah, here I am now, investing into startups, very early stage, very technical. Happy to meet you all there. And Juan, giving you a word.
Great to meet you, Sergey, and great to meet you all. I'm Juan. I've been 20 years now doing all kinds of deals, operations as well. I started my career at Merrill Lynch investment banking. Then I moved on to become a private equity investor. I went on to co-found a business called Cabify, which is like Uber for Spain and Latin America. That scaled to $1 billion business. I was the CFO there. Really exciting journey. I moved on to found another business, this time as a CEO. This was Bupos. That's where I met Andrea. We lent close to 100 million USD to B2B SaaS companies in the US. Then we exited that company. We sold it to FounderPath, one of our competitors. And I'm kind of closing the loop now since 1.5 years ago. I'm back into advisory. I'm helping founders sell the companies whenever they're ready to. That's what we, in a nutshell, do at L40.
Okay, thank you, guys. With that said, we can jump right into it. For the ones that joined a little bit late, I was telling you guys at the beginning that we encourage you to participate in the session. The whole point why there's an open Zoom is so that you can jump in if you have a burning question. You have tools such as the chat. You can raise your hand and we'll unmute you. And then, of course, at the end of the session, we'll always have like a Q&A session. In fact, if there's anything up front that any of you want to make sure that we talk about during this conversation, please feel free to leave a message on the chat now, and I'll make sure we get into it. If not, to get the conversation started, the first question I had for you, both of you, is let's start with a case study. If both of you, or if each of you could walk us through one specific company that you know that has gone from founding to exit, and kind of the key inflection points, how the capital strategy evolved at its stage, and what ultimately made the exit possible. That could be a very interesting way to begin the conversation.
Yeah, cool. I guess I can start it. So actually, I would tell you about the company I was building myself. And for the 5 years, I was building Excite, the medtech company, which increases the average check for the hospitals for analyzing the materials doctors usually don't have time to look at. So you can think about that as, I know you come in with a broken rib, you get a CT scan, the physician checks whether you have whether you need the surgery, and basically that's it. But that exact scan can be used to find out if you have some lung cancer, has some spinal hernia, a bunch of other pathologies that doctors usually just have no time to look at within a 5-minute window. So we did that back office reading, and we gave patients the better view of what's going on. We give hospitals the ability to introduce additional treatments and keep the patient inside the care cycle. And actually, we bootstrapped the company for the first few millions of ARR. So no VC money at all, just founders' cash. And at that time, we were like insanely profitable, around 90% of margins. But the sales cycle in healthcare is brutal. There are lots of regulatory stuff you have to handle, and scaling without external capital became like almost impossible for us. So that time we decided to raise some extra cash. So we raised a few rounds. First one was in Europe. We had a nice lead investor called Raw Ventures, maybe you know them. All the rounds after that were in the United States, and obviously, at that point, we stopped being profitable and started investing aggressively into this growth. So the whole market was beginning to consolidate. And frankly, we didn't really have much of choice. So you either get big as long as the market does, or you just face the big guys who burn you out. So for like 3 years or something, we've been completely unprofitable. We've burned lots of cash. We've spent lots of money on R&D, and of course, we scaled our sales processes. But by the year 5, we started getting some acquisition offers from like private equity firms, from bigger players in the market. And once we decided to sell the company, the whole new process started. So we flipped the switch, we cut the spendings, we tightened our P&L, we fired almost all of the R&D and took only the sales team and accounting team, and we became more profitable again. And I really believe that's what made the exit possible. The company who was acquiring us was not into some R&D stuff. They just had a nice cash flow. They wanted to acquire it. And timing the shift between growth mode and like cleanup mode is really important. And that's the story we had. And I'm really curious to hear what Juan did on his side.
Totally. I was thinking of a company that actually I know really well because we owned, when I was at Cabify, we owned a stake, but I wasn't an operator directly in this company. But I think it's a very interesting story. I mean, I have more. I completed that whole cycle with a civil explosives company that was a very good kind of acquisition and exit. I did the same definitely at Bupos. We exited to Founder Path, but I think this one is really interesting because it's a completely different story. It's mostly cash burning, like one of these 2010s stories in which you had to acquire market share in B2C products. And I'm talking about Glovo. Glovo is a delivery company that I know really well. I know the CEO and the CFO really well. I worked with them. Again, we had a joint venture with them in Latin America, and then we rolled up our stake and became shareholders of the group. So what's interesting about this company, they burned through cash through the whole life and huge amounts of cash. I think these guys raised like $1 billion USD. It's for those of you who don't know this company, it's like those DoorDash or Grubhub. They're in the food delivery space. They ended up getting acquired by Delivery Hero. And I think what's interesting is that they secured a number of markets. They acquired a lot of market share, and they built like very strong network effects. And for doing that, you definitely need to invest a lot and lose a lot of money, spend a lot of money, I would say. But once they did that, they had a really strong hold in countries like Spain, Argentina, which again, we built together. We at Cabify, we helped them acquire a competitor called Pedidos and a few others. And so they built like a very strong position in several countries. And that attracted the interest of Delivery Hero. Delivery Hero is a rocket internet venture. And they were clashing in certain markets. And that's one of those cases in which consolidation makes a ton of sense. because when you eliminate competition, you might get smaller competitors, but ultimately the synergies that you get and the market position that you achieve is much stronger than the risk of these new competitors getting there. And I think what was interesting is that Delivery Hero started acquiring a 20% in the company. Then they slowly acquired several investors, and that included ourselves. We got like a 4x return on our investment, so that was pretty good. And ultimately they own like 40% of the company, and at that point in time, it made sense to just consolidate it. I think one lesson learned perhaps here is that timing is time is of essence. When they tendered for 100% of the company, the deal was really good. They were acquiring, the Delivery Hero was a publicly traded company, and they were notably trading at very attractive multiples. But when the transaction closed, which was like 9 months later, the Delivery Hero share price had gone significantly down, and so the return of the deal wasn't that good. It was really good for early stage investors, not that good for late stage investors. But yeah, really interesting story of how you can achieve an exit without ever being profitable by just securing market share. Perhaps those times are not coming back ever, but we're seeing similar things in AI, right? I guess.
And in fact, I want to go back to that storyline. You both talked about burning cash, and companies that were sold at a time were burning cash. If you were growing and you had your market share, it was not as important. Let's pick a random example. I'll make up a company, and we're thinking about the market today. So we're not thinking about the early 2010s. We're thinking about nowadays. Imagine we have a company. It's a 10 million ARR. In world one, or in scenario one, this company with 10 million ARR is growing at 70% year over year, but it's burning 5 million. So they're losing cash. Maybe similar to the examples that both of you have brought to the table. In world two, or in universe two, scenario two, this same 10 million ARR company is growing at 30%. So it's growing at a slower pace, but still growing. And they break even, maybe generating a small margin. Which of these two companies would you guys think they get a higher price in the case of an exit? In which industries and why? I'm thinking exit-wise. Who wants to go first?
Yeah, I will answer from the VC side, I guess. So I honestly think people frame it as like growth versus profitability, but in reality, the dichotomy is kind of fake. So you ideally want like both of that, and you ideally want to be above the rule of 40. But if you want me to break it down, I believe in fast-growing markets, winner takes most markets, like infra or horizontal SaaS. First option almost always gets a premium, so it's better grow faster than burn less cash. Just because in this markets, speed is the mode, and actually, if you're growing fast enough, you're in the rare area, and investors can easily tolerate that you burn some cash every year if margins are strong enough, and your like burn multiple is reasonable. You're just like buying some category leadership, which is absolutely okay. But in capital efficient markets or maybe more mature markets, like I know SaaS for construction, some tools for logistics, I know. Option two could be better, and in that market's growth doesn't give you dominance actually, and markets still stay fragmented. Total addressable market is capped, and the investors would prefer something more predictable, something with more disciplined cash flows. So in those categories, burning like 5 million a year looks much worse. But one more thing I would add is that for venture capital, growing 70% year over year is like not enough. And what we usually try to find out is companies which are able to grow like 3x to 5x a year. And if you're trying to make a venture capital company and you're stuck at 70% growth rate, you'd better pivot to somewhere. You'd better find how can you increase your growth rates, because like even having a 70% of year-over-year growth at 10 millions of revenue is like not enough for VCs. So yeah, I guess something like that.
Okay, very fair point. So from what I'm hearing from the VC perspective, it depends on the segment. If it's a hyper growth segment, we're looking for hyper growing companies that can have that winner takes it all strategy. If it's more mature, perhaps something more stable. Juan, what do you think? Do you agree? And maybe you can
I think,
also
well,
bring
there are
your
a few.
VC experience too, and
Yeah.
then
Let me break
transition to
this
the
down
M&A.
because I think there are a few things that I want to mention here. There's a few ideas kind of floating in my mind about this example. Well, first of all, I think both companies are somehow in the middle of nowhere, right? Because you want to look at Rule of 40. And for those of you who don't know Rule of 40, that's a year-over-year growth plus EBITDA margin. And that has to be higher than 40. And none of them kind of meet that type of ratio. So none of them are growing fast enough for raising VC money. But at the same time, the one that's breaking even is perhaps not ripe or not mature enough for a potential exit. So that's one thing. But then you have to break it down and look a lot into the gross profit, right? Because not all EBITDA, either positive or negative, is made equal. Let's focus on the company that's at 10 million and -5 EBITDA. If that company's got a 90% gross margin and it's growing 70% year-over-year, then maybe next year there will be like 17 million in revenue and 2 million EBITDA positive if they're able to kind of contain the whole cost structure. And so that would be really good for a potential exit and a potential sale. I would say that generally buyers will look at completely different things compared to VCs. They will definitely look at Rule of 40, but with kind of more intensive focus on the profitability side. So they will want to see companies that are cash flowing, ideally double-digit EBITDA margin, so 10% or more, and they're willing to sacrifice growth. So 30% growth should be good enough for an acquisition and getting a good multiple. So I would say perhaps the company that is breaking even would be closer to what a buyer would expect, but not quite there yet, if you know what I mean.
Got it, 100%. And in fact, let me follow that trail of thought. And Sergey, I promise I'll come back to you right after, but let me throw Juan a question for him. If a founder wants to be truly M&A ready in the next 12, 18 months, so short, medium term, what specific metrics would you recommend them to focus on, or what changes should they bring to the company to attract more interest and better offers?
I think it will depend a lot. If you're thinking of B2B SaaS, definitely Rule of 40 is one thing that buyers will look into. And that should be, again, combined with at least double-digit EBITDA margin or, yeah, that type of margin or higher. And then in terms of other metrics that they will look into, definitely gross revenue retention and net revenue retention. So how sticky the customer base is. I would say that having some enterprise customers will help a lot. Having some big logos on your customer list that will definitely help a lot. And other than that, obviously, the faster you're growing, the higher your valuation multiple is going to be. That's a fact. So that's what I would summarize.
Okay, good, helpful. Sergey, let me bounce back that question to you from the investor perspective. Are you here with us, or did you have to? I see your camera is off, but I'm guessing you're still connected, or did we lose you for a minute? I think we might have lost Sergey for a second. Yeah. Okay, then I'll save my question for Sergey until he's able to connect. Sergey, still not here? Okay, I'm guessing he might be having technical issues or something like that. So let me save the question that I had for Sergey, which is essentially going to be the other side of the coin. How do metrics translate from an investor perspective? I'm sure many of the ones that are joining us today have an interest on that too. But jumping onto my following question, while we give some time for Sergey to reconnect, Juan, how would you say, given that you've been a founder, you've raised a lot of capital from investors, you've sold your business, now you're advising founders on how to sell their business. How do you think founders should tailor their stories differently for investors versus buyers?
Good question. I think investors will focus a lot on the upside, will focus a lot on the story. They want to believe, they want to follow someone who's got like a vision and obviously ambition to develop that vision. And I think having that storytelling ability and skills is very important for fundraising. And I would love to hear what Sergey thinks about that. Because ultimately, when you're raising money, you want to show that you're able to kind of build something that will go like really far compared to what you have now. Whereas when you're selling, you're focusing mostly on what you built, right? And enjoying what you built and how the company is very well established and very solid, very strong metrics. There's a lot of cash flows coming forward. That type of thing, right? It's perhaps less about the vision, less about but there's also part of that. But I think that's probably the two ways of telling it.
Yeah. So Sergey, back to you. We jumped one question. There's one question I have planned to you, but we're good to have you back. I think you lost your connection there for a while. The question that Juan was answering and that we'll love your take on is, how do you think a founder should tailor their story or pitch their story differently to investors versus a buyer?
That's a nice question. I believe the stories are like completely different. So investors basically want to hear one thing, like the company is going to be huge, and you should emphasize that like at all costs. Talk about your total addressable market, talk about how fast you grow, talk about your moats, talk about your vision, and for the buyers, the story is completely different. So I believe there are two ways, two possible scenarios where actually some companies acquire another one. And the first one is like that product fits perfectly into what we are already doing. And if you're on that case, you should talk about your synergies, how can you fill the gaps in the product, what potential of cross-selling do you have, how can you accelerate the EBITDA of the company, stuff like that. I think nice example here is Google's acquisition of Waze. That's like hard to build features which Waze build, like community sharing of raw data was what Google Maps was actually lacking. And they were profitable enough, by the way. They were acquired for like $1.5 billion, I guess. Now both products are working simultaneously. Google Maps have integrated all the features from Waze into the core product. So yeah, that's one of the scenarios. But another scenario you should think of, especially if you're building something in B2C, is a fear. And that's actually one of the common reasons why the big players acquire smaller ones. Think of, I know, Instagram's acquisition. Yeah, Facebook have bought them for like around $2 billion as well. They were pre-revenue. Nobody knows that days about how big is gonna be the Meta's ads network. And the only thing which was like the reason for acquiring the Instagram was the fear of having a big competitor. Instagram was growing like very fast, and it was not really synergetic with Meta's products, but they were scared, and that's why we've bought them. So you should always think about that kind of things. Yeah, to sum up, investors usually buy the future, and acquirers buy your like fit into the current ecosystem, or they buy your as a threat. something like that.
That's a very interesting point. Many times it's easy to forget that there's human people behind this kind of decisions, and the emotional component, the psychological component, might also have a say, such as the fear element that you were talking about.
Yeah,
And
absolutely.
Sergey, that links well to the question that I had for you, which is now looking more at the actual facts. So we've talked about the emotional component. What about the metrics that investors are looking for? So Juan was talking about metrics that buyers are looking for and how a founder must prepare or can prepare for an exit. What's your take if we walk through the stages of raising capital, pre-seed,
Yeah.
seed, series A, B, etc.? 3, 4 key metrics that you will look at on each stage as a signal of healthy growth.
Yeah. I mean, if you talk profitability versus growth, I would say that you should never pay attention on profits during early stages. That's like pre-seed to Series A. That are mostly investments into the founders, into the team, and obviously you have to be very aggressive about the growth on that stages. You have to build strong cash positions, of course, but the only thing you should do is somehow find the working products, find the channels which can generate you leads, and that's the only case. You don't have to overspend on acquisition before you crack that, but once you've done, you have to grow like 3 to 5x every year, and that's the game. So I wouldn't tell we have any specific metrics for early stage companies in terms of like growth and profitability. Of course, we would love to look at cohorts, how healthy are them, but that's not like a requirement. We would rather invest in a bold team than a bad team with nice metrics like right now. And if you talk about mid stages, I mean like Series B or Series C, I believe strategically that is the best room for a company to build optionality. And I mean, you will have to be both like profitable and growing very quickly. So you have to make yourself an engine that generates your efficient customer acquisition. You need to expand to adjacent verticals. You have to penetrate your current vertical more and more. And benefits of making yourself that optionality, benefits of having both profitability and high growth rates are like enormous, which will allow you to fundraise on your terms, which will allow you to survive during the bad periods of like macroeconomics, etc. So yeah, at times we look more carefully at the metrics. I believe Juan mentioned them really nice. We look at the cohorts, we look at the retention, and on that stage, yes, actually product market fit is retention. So you have to be building some nice enough product that customers love it, customers come back to your product. But on the later stages, something when you are close to the liquidity event, be it IPO or some acquisition, you need to start to grow fast once again. You have to show very nice figures to the acquiring part. So I would say that things are not linear. You should be very aggressive about the growth in the first place. You have to build yourself some backup plans in the middle, and you have to grow once again at the later stages. And metrics are all different. Metrics are usually more about the vertical, about the industry and business model you're working on, but the main rules are like that.
Okay, so I'm hearing growth is kind of there in the beginning. And then at what point would you say profitability stops being a nice to have and actually becomes a mode or like important in your world? And then Juan, that question will go back to you. So Sergey, do you want to continue that?
Yeah, of course. I believe that profitability can become a mode only when it actually changes your competitive power. So one way of having a profitability the mode could be very mature categories. And most of the industries one day come to the point where everyone's growth slows, customer acquisition cost spikes, churn stabilizes, and actually most of the metrics are pretty similar across all the industry. In that case, only the profitable player can outspend others. Only the profitable player can survive macro downturns. They can price cut competitors to death. And that's a very important case where you have to be profitable. Another, I believe, can be having a business with very heavy fixed costs and economies of scale as a boss time. Like I know you can think Cloudflare as a great example. And in that industry, if you are big enough, nobody can just measure economics, and your scale and your profitability can actually become your mold. And the last one I would mention is industries with very high customer acquisition costs. And I would say very high customer acquisition cost payback. If it takes you like 2 years to recover your CAC, unprofitable players just cannot scale. That's very similar to what we had in our business. And the profitable ones just self-fund the growth. So that becomes a capital access mode. I believe it's a very nice place to be profitable. Yeah, I think that's the main cases. I would love Juan to expand me and give some more.
Yeah, and in fact, Juan, for you, I'm gonna take it one step further. Like, how important is profitability from the acquisition perspective, and how does it anchor valuations?
Good question. You know, I was thinking that when I joined Cabify, the CEO, Juan, which is a great guy, I asked him, Juan, how long can we hold losses? I mean, how long can we afford to be negative, and how long will investors support us? And his answer was very clear: forever. I remember that. But he was referring to the fact that if you're scaling notably, if your unit economics make sense, so you're spending customer acquisition cost in really good customers that have a very good payback, then obviously you can afford taking losses if there's kind of no perspective of growth slowing down, right? You can afford it. You start to not be able to afford it when your growth slows. And that's the point in which you can start thinking of, what should I do with this company? Should I just sell it? Should I figure out a way to just turn a profit and continue running it for as long as I want to? But that's it kind of all makes sense when you start start seeing signals that you've reached the boundaries of your total addressable market, right? And your growth is starting to slow down. And that's the point in time in which you have to figure out, first of all, let's be profitable so I can be independent and make all the decisions. And then let's figure out an exit. And then when you're exiting, I think profitability is relatively important, because in the end, buyers like to invest in assets they like, but they don't want to have to invest. Like, they don't want to need to put some money down the day after the acquisition for extending runway. That's something that people don't like. So that's why you have to be profitable when you're exiting. Does it anchor valuations? It depends a lot on the business. I think if you look at kind of the last 20 years of acquisitions or even more, you will see that the highest correlation of any single metric with the exit value is growth. But at the same time, I think it depends, but generally investors value a lot of the company's cash flowing, because that's a very kind of, that gives you a lot of peace of mind. You're investing money on something that will give you cash flows and cash flows and cash flows.
Yeah, awesome, great answers. And for the last kind of 5 to 10 minutes of discussion, again, audience, I haven't heard any questions from you yet. I'll put the spotlight on everyone who's listening in a few minutes. But kind of the last question that I would have on my end is we've been talking so far a lot about the companies per se and kind of the metrics that we want, the growth, the profitability, that balance, a little bit what investors and buyers are looking for. But what about the market? The third component that at the end of the day can also influence the entire process. With that in mind, based on your experience, guys, what are the best and worst times, would you say, for a founder to run a process for either raising capital versus a sale or selling the business? Mic drop.
So I'll start. I really think you have to look at fundraising only at one point of view, and you should think of fundraising as a growth lever. So you have to fundraise when you have to scale, when you have to grow faster, and when your own cash flows don't allow you to do so. So I don't think there is a reason to fundraise just in case or fundraise to feel safe. So in reality, the best moment to fundraise is when you want to grow faster. You already have something scalable and you want to switch the lever. But besides that, of course, you should have nice positions when you're having that negotiations. So it's better fundraise when you have enough cash on the bank, when you have nice margins, when you're already growing kind of quick. So yeah, I think you shouldn't fundraise just because. You should fundraise when you want to scale faster.
Agree. Yeah, and then exit-wise, the M&A market is cyclical. I get asked a lot of times, is the market good for selling my company? And I get that question. Obviously, the market is cyclical. There are highs, there are lows, there are good moments, bad moments. But I would say that more important than that is your company good for a sale or ready for a sale? And that's the point in time in which a sale will be much easier. Good companies get sold regardless of the cycle. Bad companies don't get sold regardless of the cycle. So that's, again, meeting those kind of metrics and kind of high-level themes that make a company sellable in terms of, again, having a solid product, having a solid mode, having the metrics in the right place. That's what's going to make you exit regardless of market conditions. I think probably I agree with Sergey. In the end, for an exit as well, you want to sell when the company is doing right? Rather than just stretching it. Oh, the company is doing well, so I don't need to sell. Now the company is not doing well, so I have to sell. Well, maybe that's the right time for you to focus on your operations, fix what's wrong, and then after some time, if you still want to operate the business, then don't sell it. But if you think it might be the right time for you to monetize, then go ahead and sell it.
So fundamentals, guys, at the end of the day, yeah, the market is cyclical, but fundamental, and make sure you're on track and that you're aligned with your objectives and the company's performance is aligned with your objectives. And on this regard, and I know I said the last question was going to be my last question, but I have one last question. What about hype? We're hearing a lot about AI right now. How do you guys think, or what do you think separates hype and those buzzwords from actually long-term value and, let's say, AI companies?
I'll give you the basic formula of like alpha X plus beta, which we all know. And I see that most of VCs look at the beta, which stands for like background, elite schools, like companies they worked at, fancy logos, And at Orion, we are trying to look more at the alpha, which is in physics acceleration, and we recall it for velocity of learning. And I really believe that on long term, a founder who learns insanely fast always outbeats founder who started with a higher base. So on the early stage, there's other thing you have to look at, and everything else, like the product, the market, everything will change, and only that thing is constant. But But of course, beyond that, all the classic patterns still apply to AI. You have to have some real modes, data mode, maybe network effects. You have to have really deep domain knowledge. You have to build some data loops. You have to build some viral loops. You have to increase the switching costs. You have to compound over this over time. So I don't really think that AI market is much different from what we've seen at the SaaS era, for instance. But still, it's all about the people. So people are what we are actually looking at in the first place.
Yeah, I guess that it's a little too early for me to answer that question. I think AI at this stage belongs more in the realm of fundraising and scaling and growing rather than exiting. I don't think at this stage it's that much of a driver for M&A. That being said, buyers are looking into it as, will AI significantly impact this asset that I'm acquiring, either positively or negatively? And then are these guys using AI for meaningful advantages versus competitors, or creating a moat around their business? And that's kind of part of the whole M&A kind of discussion, but it's not a key driver at the moment. I think at this stage, it's more about figuring out whether Orion and all these people will invest in the good AI companies or not, and then we'll see them mature in a few years from now, and then that will kind of move to the M&A space.
Okay, and I see we got a couple of questions here. The first one is, please share your opinion about humanoid robots and their future.
Yeah, at Orion, we actually don't invest in humanoid robots at all. So I think it's more about some science fiction at the moment. And at the capacity of like 10 years, what we actually bet on are non-humanoid robots, but robots for specific industries who are tailored to solve some specific problems of the market. And that thing is where we see some real ROIs right now. That is still market which is on the very early stage, but that's what we actually bet on. So I think there are nice companies doing some humanoid robotics, but that's not the thing which will surround us in the nearest future.
Okay. Juan, do you have any comments to add to that?
Nothing to add on my end. To be honest, I'm not knowledgeable about that topic to give a good answer. So.
Okay, so Armen, you raised your hand. What's your question here? Feel free to.
First of all, thanks for the great panel. Really, can you hear me?
Yep.
Yeah, we can hear you.
Yeah.
Where are you
First
calling
of all,
from?
I'm from Yerevan, Armenia. Currently, I'm
Okay,
there.
nice.
Yeah. First
Nice.
of all,
Thank you
thanks
for
for the panel. Really interesting, a lot of insights. And I want to give one particular question. How do you view that in the current AI landscape, the current cost of AI is really high? So the token's price is really high. And even a lot of AI companies, they deliver value, but still they are burning significant capital just to run and scale the product. So sometimes you deliver the value, but the self cost of the AI is higher and you're burning the investor money. What do you think regarding this change?
I think it's okay. That one, yeah, for you. I can answer, yeah.
Yeah, I mean, value doesn't equal profit, and that's true. And I believe there is two concurrent races right now, and the first one is what's going on the foundation layer, and that's about the game of achieving AGI first, and lots of the companies are doing that no matter what. I mean, all that acqui-hires with hundreds of millions paid for one exact person, you name it. I believe it's all about increasing the probability of you being the first at AGI for, I don't know how much of persons, maybe 1/10, maybe 1/100, but it doesn't matter. If you achieve AGI first, you will probably own much more. So that's a game. You can participate in it. You cannot participate in it. It's based on your preferences, but that's what companies on foundation layer are doing. And given the application layer, some companies doing AI agents, companies doing AI for real businesses. I really believe that the market is insanely early right now, and we tend to overestimate what we can achieve on the short-term period and underestimate what can we achieve on the long-term period. So we still see that compute prices are lowering for 10x year over year, and there is some conviction in convergence of all the burns. But still, we are yet to see companies who are really disrupting the markets. So the chances are most of the companies which are building some AI today will change, and other players will come up and actually make some real changes. Yeah.
Yeah. I think what's interesting about the AI space is that it's huge. I mean, it's early, but at the same time, the bet is much bigger than in previous kind of waves of VC capital raised, and that's what makes it exciting. There will be winners, there will be losers. I think we have come to a point in which we know for sure that AI will have some good applications that will replace a few other tools and services that we're providing. There are question marks on whether it will replace some others, and that's what everybody's betting on, perhaps. But we will obviously see some disappointments. We will see some winners. Who knows? But I think it's really interesting that so much money is being invested in this technology, and I'm pretty sure good stuff is going to come out of it, even if there obviously will be losers.
Yeah. And I mean, if revenue is real, unit economics can lag for some time, and there would be companies which will survive. But actually, the whole game is very tough, and that's one of the reasons why Orion doesn't invest in the agents at all. So we are more about shovels during that gold rush, and then invest in something more sustainable.
Okay, super interesting. I see a couple of hands that have been raised. Reed, Lisa, I got you. But first, we had a question on the queue from the chat from Alex, and I believe, Juan, this one is mainly for you. It would be, what are the 1 or 2 key mistakes that you see when founders want to sell?
I think one mistake that I generally see is kind of trying to just go directly into a sale without understanding the whole implications of the process. So you think you're going to sell, and then the day after you're going to cash out and leave the company. That's not going to happen. You're going to be staying for 1-2 years at least, kind of running a transition, and you have to plan for that. You will have to, if you're leaving, you will have to figure out the management transition, and that you can do with the buyer. But those are things that you will have to do. It's going to be an intensive process. Even if we, for example, as advisors, take the lead and we make sure that we do all the heavy lifting and so on, you will also have to be involved because buyers will want to speak with you as a founder. So having a sense, also your metrics, you have to prepare ahead, right? You don't have to just call advisors and tell, I want to sell my company, I want this done in 6 months. Well, there might be some preparation ahead if your metrics are not quite there yet. So those things are the ones that also understanding valuation, understanding if you have investors, what their valuation expectations are, and aligning them all. I think what we see is founders being anxious about selling at some point in time because they see something changing in the horizon. And I think you have to kind of take everything with a pinch of salt, take look at the advice from your obviously advisors, but also speak with your investors, think about it and plan ahead.
Okay, Thank you. Sergey, I don't know if you want to comment on this one. I know it was more from the M&A advisory perspective, but if you have anything to add.
Yeah, I mean, we invest a lot in companies doing some IP which can be sold. And I won't give any examples of mistakes, but my advice for some of you who are building some deeply technical products is always think about IP you're building, and remember that for many different companies, many different industries, that IP itself can be a very valuable thing. So it's not only about selling the cash flow, but also about selling the IP, the team who can build something. And you should always remember that.
Thank you. And Reach, you raised your hand. Let us go ahead and unmute you. So if you want to go ahead. Okay, I think, Lisa, can you help me unmute Reach? For some reason, it's not working on my end. Okay, Reach, I think you can go ahead and unmute yourself now.
There we go.
Yeah,
All
there
right.
you go.
Yeah, great.
Okay.
Yeah, thank you. Thank you for all the help getting on the technology.
San Francisco in the house.
Exactly. A very interesting conversation, and Juan, and I appreciate the discussion. I was focused on the profitability as a moat comment that was made. I think both by Juan and Sergey, and I was just thinking about and the comment that like AI is really in a sort of a venture stage, right? It's in terms of the cycle, and now you have like the hype around Google's Gemini 3 product and how they will be able to take profitability from their other business lines, right, and dump that into the cost, the cost to consumers essentially, and drive down the cost of consumers for use of these models, and how that's going to put like a tremendous amount of pressure on some of these other models like OpenAI, for example. I'm just curious, Juan, Sergey, if you guys had a thought about that, because I think that kind of fits into the thesis, or fits into the discussion you were talking about profitability and moats.
I would say that partially I mentioned that before, and for the most reasons, foundation models can become profitable right now because compute is very expensive. And the thing is, price of compute is lowering year over year with dramatical amount of with dramatical scale. And if you look at the crypto market, it's a nice example. If you remember that ASICs from I don't know 2013, maybe nowadays the same priced ASICs can produce like 300,000 times more of that compute used to produce some crypto, and that's the main reason. We usually underestimate how far can we go in terms of lowering the cost, lowering the prices of cost of goods sold, and I believe that's one of the reasons how they can achieve profitability. But another scenario, which is always in the minds of CEOs of Google, of OpenAI, etc., is actually achieving the AGI, which sounds like kind of interesting for all of us. But that's the thing they actually pay lots of attention to, and I've spoken to lots of OpenAI employees, for instance, and most of them are spending like 80+% of the time actually building AGI, not building the application for like chat, but actually building the AGI. And we don't really know what's going to be the times. We don't even know how powerful it's going to be. But if somebody achieves that point, I believe all the capital expenses that were invested before wouldn't matter like that far.
Yeah, I'm a little bit more skeptical about AGI, but I do definitely think that the unit economics of of AI will be very different to what we have now in only a couple of years from now. I'm pretty sure we've seen that in other markets. You know, the exponential growth of computing power, the new technologies coming in computing as well that can help drive better economics for AI. So that's definitely going to happen.
Thank you.
Okay, awesome. We're almost on time. We do have a couple of minutes left. Thank you, Alex. Hey, Miami in the house as well. Awesome. Thanks for joining. We'll send the recording. Lisa, you had raised your hand, so perhaps this last couple of minutes can be for you.
Yeah, sure. Thank you, Juan and Sergey, for the amazing panel. I guess my question would be how the AI is changing the topic that we're talking about, the profitability versus growth mindset, because now with all of the AI technologies, you can afford much faster growth, much better revenue numbers with a very small team. As I don't know, NFX suggests, with a 3-person team, for example, you can build a unicorn right now. So does AI implementation in the company change the requirements for the numbers of the company?
I can start, and I really think that for a long amount of time, basically your headcount was a nice metric of your success. How big is your office? How many people do you have, etc. But AI is changing it completely. So I think Cursor, who hit 100 million of ARR with just 12 people inside, and that's becoming more and more important. That's becoming more and more often when companies with very small teams achieve very significant results. And that's a trend which doesn't affect all the industries. So it doesn't look at all the companies like, oh my God, you have more than 5 people, we don't invest in you. But still, for the most cases, like SaaS businesses, like not enterprise-led sales businesses, having a small team at the early stage is very important. And you can just have a much longer runway if you stay small. You have much more room to test hypotheses. You have much more room to fail. And that's why I guess it's important. Another thing I think you can think of is revenue per employee, which is a very important metric. Maybe Juan will talk about that later. And if you look at what companies have the highest revenue per employee, that usually the company is generating lots of cash and having a very small team. Yeah, like Valve, I believe, have around 300 people. OnlyFans have only 40 people. There are lots of examples like that. Twitch maybe, yeah, under 1,000 people, I guess. So staying small is really important. It allows you to move faster. It allows you to cut some operational troubles you will always have when you are big. And on the early stage, it also gives you much more of runway. So yeah, it changes right now.
Totally agree, and yeah, not much to add. I think revenue per employee is definitely a metric that everybody's focusing on these days. There's a question there, like, do you believe in solo founders? I don't know exactly whether this refers of this kind of thought that someone will build a billion-dollar company by himself, like with only one person, without employees or anything. I think that could happen. I mean, you have some examples of companies that have scaled significantly with very few people, and if you're able to master the product market fit and the go-to-market scaling stage, that could be something that could happen. But if you're asking about whether it makes sense to be a solo founder, I was a solo founder once. It feels very lonely. I do believe it's possible and you can achieve great things. But sometimes it feels good to have someone else to discuss your inner problems, right?
Yeah, and to add some, I think the market is starting to believe in solo founders. So we see more and more venture deals where solo founders are being funded. And actually, VCs hired solo founders for a very long time, but now it changes. I still think that having a second mind is very important, not only in terms of like separating and like somehow dividing the execution between you, but also in terms of having another person who is like fully involved, who are fully committed, and who also thinks about how can we make the next move. So we are more likely to invest in companies with several founders, but I believe there could be lots of success stories with companies built with only one founder.
Okay, well, I think that was a closing question for now. Thank you, Juan and Sergey. Thank you, everyone who joined and participated.